Welcome from me, Guy Monson, to this month's 6-Minute Strategy. As we look back on 2025, it's clear that global equity investors saw markets rise, but it was still a counterintuitive year. Despite growing geopolitical rivalry and rising tariff barriers, markets delivered a strong, risk-led rally. It was driven largely by retail flows, high-frequency traders, and indexing strategies, at the expense of long-term quality and thematic investors. Looking ahead to 2026, the backdrop should be more supportive for quality. Global growth is likely to run hot, especially in the US ahead of the November midterm elections, while inflation will stay above target, but only modestly. Together, these are conditions that should support equity markets while allowing quality stocks to lead. 2026 will also be a year of fragmentation, economically, politically, and across technologies. This will be a world of competing global powers, tariffs, and a rush to lift defence spending. In the slides ahead, we highlight 5 key opportunities for investing in today's fragmenting world, ideas that we believe should help drive performance and build stronger, more resilient portfolios in the years ahead. So let's look at 2026 through an economist's eye. They'll see a world of competition, of sanctions and tariffs, growth that's broadly accelerating, but inflation that's a bit sticky. This will be especially so in the US, where President Trump will be very keen to support consumer incomes going into the November midterm elections, and that will probably mean higher inflation. That's possible because he may have a more compliant Federal Reserve. In China, almost the reverse is true. There's property problems sending a deflationary pulse still through the whole economy. The result is a massive export drive, and that is undermining profits and margins across Asia and much of Europe. In Europe itself, expect growth to accelerate, driven primarily by the consumer. We would get a big boost, though, if there was news of a Ukraine-Russia ceasefire. That would lift consumer and business confidence substantially. In the UK, the growth numbers are going to be strong. That's largely because a lot of the government spending comes in now, but the tax rises are backloaded to the end of the term. We'll look at that in more detail. In Japan, loose monetary and fiscal policy leads to strong, again, nominal GDP growth. So let's look at that nominal growth in a chart form, and you can see that we're clustered around the 4 to 5%. China, interestingly, at the bottom, that's that very low inflation, which is not reflected in the raw data, compared to the UK at over 5%. And you see how underlying government spend is really accelerating that economy and will put pressure on inflation. Let's look at that UK story in a little bit more detail in the aftermath of the last budget. The next 3 years will likely see a mildly expansionary budget because those dark blue bars there, which are tax rises, don't really cut in until 28, 29, 29, 30. In the meanwhile, that black line, total impact on borrowing, shows actually borrowing rising for the next 3 years and only then beginning to fall. In short, the government has penciled in big tax rises for the end of the decade. Thirdly, of course, across the world, but particularly in the US, a huge impact of AI spending, and particularly that on data centers and related activities. In the left-hand panel, you can see that information processing equipment soaring the production levels compared to industrial equipment and transportation equipment. In the right-hand chart, the similar message in intellectual property and product software, grabbing all the latest demand, soaring up there as AI demand it affects so many underlying areas. So let's put these all together in 5 key strategies for investing in 2026. The first one, of course, is the world order is becoming more competitive and rivalrous. That undermines trust in the dollar. People will go for national champions, they'll look for research security, they'll look for key security over metals, food, and of course semiconductors. All this backed by persistent longer-term dollar weakness. The second opportunity, the US is much less willing to underwrite global security. Rising defence and cyber spending is going to have to be met by other countries. This means enhanced European military spend with huge potential allocations to cyber protection, missile defence, everybody will want missile defence for their own country and space, and even drone protection. Thirdly, spending on ageing climate and defence will raise deficits and overall debt. Higher bond yields will be good for savers, and there will be a point where we can lock into some of these long-dated government bonds, but we're not there yet. Gold will continue to be robust, and of course banks do love a sharply steeper yield curve, and that'll be good for their underlying earnings. Fourthly, remember that less efficient supply chains, climate risk and tariffs all create higher and more volatile inflation. Keep your portfolio broadly adjusted to real assets, equipment that helps in climate mitigation, and inflation hedges, equities, gold, metals. Fifth and finally, the 2026 is going to be another great year of innovation that will support nominal growth and profits. Expect AI-led productivity across services to surge, particularly in financial services. Expect great leaps in robotics, self-drive, improved drugs, and even some signs of success on nuclear fusion. This is going to be a very powerful innovation-led economy for the world over the next year or two. Well, I hope all of this is useful. I hope it gives you some markers for 2026 and some key themes to embed in your portfolio for robust and successful performance in the years ahead. Thank you.